The much anticipated recession for the U.S. economy has yet to materialize. Could it be on the way, or will the Federal Reserve pull off its miracle of a soft landing for the economy? In today's video, we're going to look at the latest economic data and what it means for the U.S. economy and the housing market going forward. Let's get into it. Let's not waste any time and get right into it. We're going to look at the labor market first. After all, it's hard to make a case that we're in a recession if companies are still hiring. According to the latest data from the Bureau of Economic Statistics, the U.S. economy added 199,000 payroll jobs in November, which was better than expected, and the unemployment rate also ticked down. This was an acceleration in job growth over the 150,000 jobs in October. It was slightly below the 2023 average of 235,000 jobs, but it does send a signal that we're not going to see the labor market decline in the fourth quarter of 2023. We're getting confirmation of this in weekly jobless claims as well. After a recent peak in the middle of November, they have steadily declined in December. Add it all up and we should see decent, not spectacular, but decent growth for the labor market in Q4 overall. So Q4 job growth is looking good. But what about the underlying labor market trends that suggest what may be over the horizon in the first quarter of 2024? One metric we can look at for that is the number of job openings, which tells us the demand for labor in the economy. Here's a chart for non-farm payroll job openings, and at first glance you might say, wow, this is crashing. We're in for some rough waters ahead. And while the sharp decline does look a bit scary, we need to remember that job openings surged during the pandemic. If we look at the trend in the last business cycle before the pandemic, we are still well above the trend line. Another way to look at this is to compare it to the number of people in the economy looking for a job. When we add this to the graph, we can see that there is still a lot more job openings than there are unemployed people looking for a job. Here's a ratio of job openings to the number of unemployed. A reading above 100 means there are more openings than people looking for a job. Historically, this ratio is usually below 100, and we're at 134 as of October, the most recent data available. So while we are seeing a sharp decline, this is more of a signal that we are returning to a typical labor market where the number of people looking for a job is greater than job openings. We would need to see an absolute collapse in this metric before we were anywhere near recessionary territory in the labor market. So overall, the labor market is looking healthy and isn't giving signals that a recession is imminent. One of the danger signs we were looking at in my last video on the economy was some weakness in the U.S. consumer. This is important to watch as consumer spending makes up about 2/3 of the economy. In October, retail sales declined from the previous month, but in November, it rebounded slightly and returned to positive growth. Since that last video, we also got data from the U.S. Bureau of Economic Analysis on personal consumption expenditures for October and November, which is a much more comprehensive measure of consumer spending than retail sales alone. It also is adjusted for inflation, which retail sales are not, and it is telling a different story. In October, real personal consumption expenditures grew by 0.1% from the prior month, in contrast to the negative growth in October for retail sales, and in November it grew 0.3% over October. With 2 out of 3 months of the fourth quarter showing positive consumer spending growth, a recession starting in 2023 is a hard sell to make. And it's more than the labor market and consumer spending that are painting a somewhat rosy picture for the U.S. economy. International trade statistics are also supporting the narrative of a soft landing. In October, we did see total U.S. exports decline slightly from the prior month, but comparing it to 3 months ago, it is still up, putting quarterly growth still on track to be positive if November and December are higher than their respective 3-month prior values. Imports did pick up, which is a negative contribution to GDP, but nothing too crazy. After all, the balance of trade in October was still better than 3 months prior. Add it all up and it looks like we're headed toward a positive fourth quarter GDP number. But because of some of the data for Q4 has come in a bit soft, I don't think we're going to see a repeat of third quarter GDP growth that soared to 4.9%. Something in the 1.5 to 2.5% annualized growth would be more realistic. The important thing here is that economic growth for the U.S. in the fourth quarter is likely to be positive. If your labor market and gross domestic product are both growing, you can't call that a recession. We're still in good shape, which pushes off any recession to the middle of 2024 if it's coming that year. On this channel, I focus mostly on the U.S. and regional housing market, so the next question is, what does this mean for home prices? In my recent videos, I've highlighted the strength in U.S. housing, which has been unexpected given how unaffordable the average home is for the average buyer. But because of tight supply and plenty of pent-up demand, home prices have held relatively steady the last year. The signals coming from the Federal Reserve and the bond market suggest the 30-year mortgage rate is likely to continue to decline as it has been since the end of October, and this will provide further support to home prices, if not push them higher. The biggest risk to the housing market right now remains an economic recession, which would push down demand for housing. In a recent video, I found that a recession of average duration and intensity could push home prices down about 10%. And if supply surged at the same time, we could see home prices fall by more than 20%. But as I've covered in today's video, a recession is so far nowhere in sight. That doesn't mean it won't come. They always do at some point. That's just how the business cycle works. But we aren't likely to see one before the middle of 2024, meaning the housing market is poised for increased activity as mortgage rates come down. I'll be producing an update to the economy and the risk to the housing market next month. So if you want to stay informed on the latest trends and what it means for the housing market, make sure you're subscribed and hit that notification bell down below so you won't miss my next video when it comes out. And if you found this video useful or at least mildly entertaining, make sure to hit that like button to support the channel and help it grow. Thanks for stopping by. I'll see you in the next video.